Picture it, Silicon Valley. Suddenly an investment firm materializes on the scene and starts writing checks bigger than anyone's ever seen before. People start to privately complain. They're posers, they're driving up valuations, they're gonna ruin venture capital. I'm actually talking about Andreessen Horowitz, circa 2010 and 2011, but it could easily be SoftBank, whose $100 billion vision fund now makes the bold bets of Andreessen and other firms look pretty quaint in comparison. So I'm very happy to have these guys with me. Jeff Housenbold, some of you may know, joined SoftBank in June of last year, and before then spent about a decade leading the personal publishing company Shutterfly, which I guess went public in 2006. He has been very involved in a number of Silicon Valley companies since as an investor with SoftBank, leading deals in WAG and Katera and Brandless, among others. Seated beside him is Anna Lowe, who I'm also very happy to welcome here. Anna has been with SoftBank since 2006.
That's correct.
You spent 4 years before that as an investment banker with Deutsche Bank, and you've since been involved in a variety of SoftBank's international and regional activities.
Right. I think my whole investing journey has been with SoftBank. In 2006, I was managing an early stage fund that was 100 million in size, and had the opportunity to relocate to the Valley as part of the acquisition and integration team for Sprint. And as part of that, we sourced businesses investing opportunities to do business with SoftBank family companies. At that time was also fairly global. And we started making direct investments in India, such as Ola Cabs, Oyo Rooms that are now part of the fund. And here we are with the Vision Fund.
That's great. You mentioned Oya, which you just led a $1 billion round.
Yeah, that's right.
Congratulations. So, part of my mission tonight is just sort of like with Jewel. I kind of want to just better understand how this company works internally. I mean, there's lots of speculation about what goes on inside SoftBank, but I figured, who better to hear it from than the two of you. So first, how many people are sort of running the Vision Fund at this point?
So there's about 86 investment professionals around the world. We have 3 offices, one in Japan, Tokyo, London, England, and then San Carlos, California.
Okay, and I guess walk me through a little bit how you identify a company that you want to approach. I mean, it seems like you're often going after the sort of biggest names in a particular sector. Is it that simple?
Definitely leaders in their respective markets and geography. An excellent rockstar team. We are very friendly and collaborative with our founders, so we need to see eye to eye on their vision. And I think, a lot of criteria is not, too different from other fellow VCs here in the audience.
Well, in terms of metrics, what do you want to see more specifically?
So, in the continuum of venture capital, we're late stage growth. Our minimum check size is $100 million. We're looking for a product market fit, some revenue, and traction before we typically come into a deal. So it depends on what industry and which company. It could be GMV, it could be revenue, it could be if it's an enterprise software portfolio company, it could be how many clients do they have, the diversification of the revenue, what the repeats and the retention rates. So it really depends on the industry and the company, but we look for product market fit, companies that are growing very quickly, who could deploy a lot of capital in a differentiated way to either capture new customers, market share, enter into new geographies, expand their product portfolio, or move into adjacent markets.
How do you think about making that first call? Because there's so many stories that get leaked by companies, SoftBank's talking to so-and-so. And I would guess that when they get that call from you, it's sort of exciting and nerve-wracking, because you're clearly looking then at a certain sector, and that means you're probably not just talking to that company, and if you decide not to talk to that company, you're talking to others. How much sort of thought do you put into just that first phone call, or is it not that complicated?
Yeah, a couple of thoughts, Anna, join in. So it really comes in 2 vectors. So one, we'll do landscape studies and have strategic hypotheses around certain sectors and how technology is impacting that sector and driving innovation. So let's say in the real estate sector, we took a scan and looked at over 80 different companies across different aspects of the value chain. So we've already mapped out which are the incumbents, who are the up-and-coming startups, who's differentiating themselves, who's getting traction. And then we have a thesis where we think the economic rents, where can money be made in those value chains, and then we go and approach those companies. So that's one approach. The other thing often is the phone rings, as you can imagine, when you have a large fund, people call us opportunistically. So sometimes it's like, oh, you know, we looked at that 8 months ago, maybe we should take another look because now a new player has entered, or this company has gotten more traction, or they completed that merger they told us about, or they moved from 20 million in ARR to now 100, and we'll come back to that because they've called us. And so it's a combination. We try to be as strategic and proactive as possible, but sometimes it's more opportunistic. And through that exploration, because we'll never just invest in the company who just met with us, we're going to go do a landscape study, understand who the competitors are. Sometimes we go, oh, we got introduced to online courses through meeting with company X, but what we really realized was the application was not to consumers, it might be in corporate training. And that will take us down an adjacent path that we might not have thought about. And then half of what you read in the press, as you can imagine, is fake news. So companies are now using our names to create competitive tension in a term sheet where we've never even met with the company. So we have a database like all of you do, and so I'll read in the press, oh, we're investing $1 billion to so-and-so company. I'll log in, no one's ever met the company.
And then are they like permanently off your screen?
It doesn't go well internally, yeah.
I'll give some color on global investing. You know, one of our early successes was Masa's $20 million check into Alibaba, which is now hundreds of $billions in value as of today. And you know, looking for successful e-commerce models in other emerging markets that are beginning to display characteristics similar to China in terms of the rising income, the adoption of mobile internet. So we would do that globally because, you know, we have the resources spanning across European, American, and Asian continents.
And then what does this sort of decision-making process look like? So there's 5 managing directors, you're one of them. Do you talk for an hour or two and, you know, it's majority rules, or how does it work? So for example, my team looks after consumer and real estate. So if it's a deal in consumer and we're intrigued by it, we'll do a bunch of work. We'll meet with the management team, we'll do some outside in and inside out research, we'll come up with a investment thesis, and if we have conviction internally, we then take it to the managing partners and we ask the management team to come back and meet all of us. If there are no major objections, then what we do is we bring that to our global deal call where partners around the world come together once a week and we walk through our investment case. And Masa is on that call often, and he'll say, I'm intrigued, bring the entrepreneur to Japan. So Masa meets every single entrepreneur that we invest in, which is a phenomenal asset to have because he's brilliant. He's seen, he sees 10 or 15 companies a day, and he has amazing pattern recognition. But what's really amazing is he's fearless. And he will sit with an entrepreneur and go, I really love that concept. Have you thought of X? Or what if we removed barriers? Or what if capital wasn't a restriction? Or what if we could land you a CFO, a CMO, and a CPO tomorrow? What would you do different? And it's fun to be in that environment. And so we'll take the entrepreneur to see Masa. If Masa says, yes, I'm intrigued, move forward, then we go to our formal investment committee, we do confirmatory diligence, and then we close the deal. There was a story in the journal recently that was interesting because it talked about how brilliant it was, but it also sort of painted a picture of him being slightly impulsive. And they said sometimes he, gets so excited about a company, he'll basically do the deal ahead of time and then, or rough out the deal terms and not leave much for his very smart, network of colleagues to do. Not much for them left for them to do. Does that happen very often? And if on the occasions that it does that drive you crazy, or is it just sort of?
I think he gut reaction. He will kind of give his indication of what he believes the deal will look like. He's obviously been briefed by the partnership prior to this meeting, and yes, no, it's like the process that Jeff just described. All companies still go through the ringer of the due diligence process, the formal IC meeting, and sometimes lots of follow-up questions and regulatory approvals.
If he doesn't
sometimes where that changes is we never bring a company to see Masa that we haven't already kind of outlined what the deal terms would look like. But sometimes in that exploration where Masa says, what if you went bigger, quicker, faster? Then instead of putting 300 million in, he says, could you deploy 500 million? What would your business plan look like that? And that's where sometimes the deal terms change, because in the moment, he helps to think about, well, what if we bought your competitor and we moved quickly in doing that? What if we took you to Japan quickly? And so the deal terms often change because of that more expansive worldview and the challenge to the management team of what they could do if we remove some of the perceived barriers to building a great franchise quickly.
Right, which hundreds of millions of dollars can do. I just wondered, is it possible to change his mind? Somebody who said it's very hard, I think it was maybe in the same story, because he'll basically he'll exhaust you, when he wants his way. I'm just curious what it's like if you want something that he doesn't want, if he can be persuaded, or if he wants something that you don't want, if he can be persuaded.
Masa is a man of action, but he's also a man of facts and wisdom. So I've had several deals where at first blush he goes, yeah, I don't really get it. And I'll say, well, then I didn't do a good enough job of explaining why we have such conviction around this investment. And so he'll say, okay, come back and take me through it again, but let me understand these aspects. I've had instances where he says, I was at so-and-so conference and met this entrepreneur. I think they're really amazing. I want to invest in them. That's not a mandate to go invest. That's the permission to go explore.
Okay.
And so we as managing partners and senior deal leads, it's our job then to go vet that, put it through the rigor and the analytics and the strategic view, and then come back to us. And there's been plenty of examples where he was excited about something. We'll say, we did diligence and the tech really doesn't scale. Or sometimes it's, this is a great company, and they're number one, but we found a much better, smaller company who has better tech, better management team, better go-to-market, better execution. We think we should bet on number two, not number one, because they will pass them in 14 months. And so Moss is very open to, if you know your stuff and it's fact-based, he's very open to changing his opinion.
Yeah, I have 12 years of data points, so
Sure.
Lots of yeses and a lot more than no's.
And I did want to talk to you about the Vision Fund's sort of global strategy. I mean, everyone in Silicon Valley is sort of obsessed with what Vision Fund is doing, but I'm wondering how much of its money is sort of being invested in the U.S. versus elsewhere, and how much of that is mapped out? I get the feeling there's a lot of financial engineering going on, so is it sort of like, okay, we're going to 25% goes here and 30% goes there?
I think now it's quite in line with how global private equity is deployed. Because if you think about the biggest venture and private equity ecosystems in the world, the two largest being US and China, I think we do have today probably 50-50 US and non-US investments out of the 30 plus companies. And that's just a natural reflection of how vibrant a certain venture ecosystem is as they grow. And I think what we're seeing in Southeast Asia and in the Middle East are kind of the next frontiers for us. But the check size, would not be as large as those in China, because it will take a lot more capital to build that scale.
And how much are you looking to own of the company? I think I've read like 15 to 20%. It's sort of confusing when you see such huge check sizes and these aren't sort of necessarily majority positions. How does that work?
We don't have a set target. So we're late stage growth. We like to have meaningful minority stakes, be helpful and active board members. We're bringing not just capital, but counsel and connections to the entrepreneur. And we're a 14-year fund and we're 16, 17 months into it, so we have a very long horizon. and which allows the entrepreneurs to take the capital and build much bigger businesses without the pressure of having a liquidity event. So we don't go in it with we have to have 15 or 20. We tend to have, 20 to 35 is, what I'd say is, if it was a normal distribution, would be the 80%. But we have investments like NVIDIA and Slack that are on the lower end, but they're much larger companies. And then we have some companies where we're in the 40%, but it runs the entire gamut.
I also wondered what other terms you asked for. I had done a story for TechCrunch about a year ago about what SoftBank really wants, and I talked to somebody close to the fund then who said, "Look, I know it looks like gunslinging from the outside, but we actually, we have very sort of exacting terms, but we didn't dive into what some of those are. What do you want to sort of protect your downside?"
Yeah, so look, we're like any venture capitalist, our term sheets look pretty standard. There's a couple of clauses when you're late stage growth that are more industry norm than if you're seed. And they're just like there are normal terms if you're private equity and you're taking a control position. So our terms are typically market rate. And because we're coming in late stage, the entrepreneurs already have very seasoned, sophisticated venture folks that are sitting around the board. So they're getting great advice around what is market or what's not. And so there are times where we're protecting downside, but we are venture, not private equity. So we really think mostly about what the upside capability is and how do we align ourselves with the entrepreneurs. And I've been in so many meetings where Masa, because he's an entrepreneur himself, he's like, we want you to do really well. Because if you do well, we do well. And there's such an alignment, both on the expansive vision on building a company that's going to last and is durable from both a business model and a cultural standpoint, companies that are platforms and global in nature, and companies that, Masa is not a person who says, you know what, you have an offer for 600 million, sell. He'll be like, what do you want to do? Right? Well, I want to build a $6 billion company. Great, we're behind you.
How big a check can you write? Or what's the sort of, how much leeway do you have?
So I think our LPA agreement calls for above $5 billion, we have to get LP sign off. Nice. So and I'll have to fact check that, but it's in the billions. So 100 million minimum, I think 5 billion maximum. But for example, we deployed more than that into Uber. Okay. As an example, and into WeWork and our limited partners. We just got to get special approval for that.
Which was the bigger investment, WeWork or Uber?
I think Uber is our largest investment to date.
Together with Didi.
I'm sorry? Oh,
together with Didi.
Okay, great. Well, Jeff, last night I was watching an interview you did at Fortune's Brain Tech event in Aspen, which I really enjoyed. And you said, and I was surprised, you said that SoftBank doesn't always offer the richest price or the most money. When have you been outbid? And in hindsight, do you wish you'd bid more?
So there's actually a subtleness into that question. So I've been outbid and we lost a deal once. We've been outbid and won the deal many times. Because the entrepreneur, as you guys know, there's a marketing spin around the headline post-money valuation, and certain entrepreneurs will push the valuation, but certain venture capitalists or growth funds within private equity funds will put a lot of downside protection so that you get a big headline number, but there's a lot of structure in it. So I've been outbid and term sheets that came in much higher than we bid, but the entrepreneurs decided to choose SoftBank as their partner because it wasn't just about the valuation in that round. They were looking at alignment of vision and strategy, how patient is the capital, the connections, the power of the ecosystem of the SoftBank. As Anna mentioned, we own companies like Sprint and Yahoo Japan and SoftBank Mobile and ARM, and then we have investments in many companies around the world, and our sister companies tend to work together. And sometimes they're choosing us because of our backgrounds as operators or investment bankers or as board members, because it's a differentiated skill set that you bring to the board. So I've lost one deal. I thought we were stretching to get to the valuation where we were, and a very well-known, and I won't tell you, but a very well-known venture firm came in and bid 35% more, and I was happy to walk away.
Wow.
I think earlier in the fund days, one of my personal concerns was, will we be outbid by speed? Because we went from a direct investment off balance sheet, slightly simplified investment process to now managing third-party money, a very formal IC process. You know, could we possibly lose on that timing? But as Jeff said, we've proven that with our ecosystem of entrepreneurs, you know, the entrepreneurs see the value that we bring, and they are patient with us, and we are the patient capital and taking the long-term view.
So when you're competing against private equity, you sort of are suggesting that you win every time if it's sort of a company that's looking for more sort of stewardship. It does bring to my mind the question, do you have vice clauses?
We do.
You do, okay. Because, you know, Jewel was here earlier, and Tiger is an investor in T. Rowe. Is that a company that you've looked at?
So we have some prohibitive classes of investments in our LPA. Pornography, tobacco, alcohol, drugs are the four that come most to mind. And weapons, thank you.
Okay.
So no.
Can I ask what you think of it as a company? I mean, if you weren't hampered by vice clauses, just as a sort of a smart, you know, investor who sees the business story but also sees the challenges.
Yeah, I think what was said on stage, and I think you said it well, is they've locked on to product market fit, and it's a company that's growing tremendously. And so there's a market for it, and they need to thread that careful needle of being a better alternative for people from a health standpoint than smoking, but not generate new users of the product that gets people addicted to nicotine and some of the other ingredients. And so it's a fine line. And as they indicated, most of their sales are outside of the US, and so there are different social norms and laws and customs, and so I don't think it's our place to comment about what is right or wrong and what their value proposition, but clearly it's a management team who has locked on to a very profitable razor blade model, and that has strong receptivity around the world.
Absolutely. You know, a lot of people, you know, SoftBank comes up in conversation and people say, how can they possibly return all that money? So I thought maybe we could spend a couple of minutes talking about sort of your successes to date, because I'm sure there's many that I've overlooked. So Flipkart's sale to Walmart reportedly earned SoftBank millions of dollars. Can you talk about that return? Or how much?
Yeah, so in general, we made investment and we made billions on the investment in a very short period of time. We actually weren't sellers. So we didn't want to sell, but Walmart wanted to have control. And so the management team, the investors, the board of directors made a decision to sell, but we were plenty happy to roll over and retain our shares. But that was an idiosyncratic example where a very large company came in, made a meaningful higher bid than our investment just 14 or 15 months. So that is one of the, remember we're only 15 months old, so we don't have that many liquidity events today. Right. We invested in NVIDIA, which was a public company, and so we fortunately invested at a great price, and the stock is more than 2.5x in less than 18 months.
That was $4 billion that you put in last year, and now it's like the stock is up, I don't know, a lot.
It's a lot higher.
Right.
So we don't have that many liquidity events today. We've had follow-on rounds where you mark on paper. Outside investors have come into some of our investments. For example, in my portfolio, DoorDash just raised money, and there'll be other announcements this week of several others that have gotten marked up. So that we're seeing that across our portfolio. Several of our companies have confidentially filed to go public, and so like any venture fund, we're going to have our successes, and we'll have things that are, you know, don't meet our expectations. Sure. And so we're pretty sanguine and humble about it that you know, nations have entrusted us with their citizens' money as our limited partners, and it's a vast amount of capital, and so we want to be good stewards of that. And our belief over a long period of time, we're going to have a good IRR, and that we're going to be good stewards of that money.
So can you talk a little bit about what you're aiming for? So again, I had mentioned that I talked to somebody close to the firm last year, and they really compared SoftBank more to like a KKR or like a Carlyle. I mean, they basically said, look, if we do better than, you know, those guys, we're winning. Like, you know, SoftBank's going to be looking for like a, I don't know, 20% IRR. Is that inaccurate?
I think we just want to be our own track record and not really comparing it to a KKR.
Well, if you take out Alibaba, though, then,
Yeah, Masa's investment record, I think, even if you take Alibaba, is north of 40%. We're not suggesting that we have a specific target, nor are we going to announce it publicly. But I think Anna's point is right, is just like the entrepreneurs were investing, which they're bringing innovation into their industry, we're bringing innovation into our industry, and we're playing a different game. So we're not comparing ourselves to traditional private equity that take control positions, typically are more focused around cash flow and shrinking costs and then refloating the asset, nor are we going to get the 20 and 30x multiples on the frequency basis that a seed or an early stage investor is going to get. We're late stage growth, and so our IR and our gross MOM targets are reflective of being a late stage growth fund. And so we have internal targets, but they're not things that we talk about externally.
Well, maybe this falls into that bucket, though. But so at an event of mine last year, I was talking to VCs about SoftBank, which is always top of mind, and they were saying, they're going to have to produce at least 200 billion in returns, above that, minus management fees. Is that, does that sound accurate to you, or does that sound,
I think if you look at the track record, right, Masa invested, I think, $2 million into Yahoo Japan.
Yep.
And that turned into 16, 17 billion, 20 into Alibaba, turned into 130 billion. Now those were earlier stage deals than the Vision Fund, but there's a track record and a set of capabilities inside of SoftBank that we're drawing from, and then we're building an amazing team from partners all the way down to analysts and associates that have experience from all of the venture firms that are sitting here and on Sand Hill and all the private equity firms. So we're taking a very long-term view here, and we're trying to make smart decisions, but we think what we're bringing to the table for our LPs is the ability to participate in the next generation of great technology firms. Right? If we all sit here today and say, what have been the dozen great tech firms over the last 15 years, we'll talk about Facebook and eBay and Google. Like, we want to be investors in the next great generation, and if we do that and we do our jobs well, and if we're patient, I think we're going to have amazing returns for our LPs.
Is there any sort of sector where your team has looked and said, nope?
Well, other than the prohibitive sectors we've mentioned, where there's some controversy, gray, that's not, prohibited in our LPA by policy. I think lots of hard asset-heavy businesses where it just takes more resources to scale. I think, but what we've done instead is, okay, if you say real estate, it's asset-heavy, but what are the technologies around real estate that helps, make it where we can find new business models and make it, more valuable for all stakeholders.
Crypto comes to mind. So we're big believers in the blockchain technology and its application to various industries, but not big believers in currency or coins. Another example is AR, VR. After looking at that industry, we don't see near-term great investable assets on the consumer side, but we think there's industrial applications, particularly in repair, design, medical fields, and digital and surgical applications. Those are a couple that come to mind. And then industries that can't scale logarithmically, that they have to go linear because of either the sales cycle or the geographic dispersion or the inability to leverage IP across global boundaries.
Can you give me some examples of those?
So if you think about platforms like Facebook or Google or Alibaba, they could transport globally, right, and available, and you get either viral word-of-mouth effects or actual network effects in those business models. Those we love all day long. But if I got to build a hardware right? So we stay away typically from hardware plays because you got to manufacture them one at a time, and then you have to put a plant in another location. So you get local geographic scale and scope economies, but you can't make that plant so big because the shipping costs are prohibitive and the time to market. So you got to open multiple manufacturing plants. That would be an example that model will take too long to kind of hit the inflection curve.
Great. Interesting. So I mentioned when we sat down that everyone loves to complain about SoftBank. And I hoped you would indulge me. Nothing in here is going to shock you, but I wanted to sort of run past you some of the things that I hear, day to day when I ask people about SoftBank and let you sort of take them on while we're here. One is, and you talked a little bit about this at Fortune, that you use money as a weapon, and in the process that you're driving valuations to unsustainable heights.
Yeah, so I think what we talked about at Fortune was we use capital as a strategic differentiator. So if there are 5 players coming into the online training industry, or 5 players coming into dog walking, or 5 players into RPA, or whatever it is, often what happens with venture capital is an idea comes about and 10 or 15 companies get funded. I was on Groupon's board and there were 412 Groupon copycats around the world. At Shutterfly, there were 1,140 venture-backed photo companies.
Wow.
So, right, not all those are going to survive. The customers or the consumers don't need that many choices. And so we're able to use capital to basically help. You never, right, still execution, you have to have a great management team, they got to make the right strategic decisions. But a large amount of capital can help them acquire customers, hire engineers, develop product faster, get to market faster. So our size of capital can be a strategic differentiator. So we're not embarrassed by that at all. It is, every entrepreneur goes, yes, I would love to have that.
Well, you've been in the business forever, so this is not the first time you're going to be hearing this, but obviously there's concerns sometimes that you can actually drown money in capital. So how do you, and there are concerns that you're doing that, or, like the information recently about one of your companies, Katerra, which is a construction company that's sort of trying to build things faster and more cheaply than contractors and subcontractors can. But it's run into some problems. I don't know if that has anything to do with the funding, but it sounded from the story like it was a company that raised a lot of money before maybe it had everything sort of hammered down, if you'll forgive the pun. Is that ever, why is that not a concern?
Yeah, so I'm on the board of Katerra, and so I could tell you a lot of what was in that article was not particularly factual, but also completely generic, right? And so the comment was, if you're going through hyper growth, are you going to make some hiring mistakes? Of course. If you're buying 17 companies in 3 years, are there going to be some people who have redundancy and post-merger integration? You don't need 2 of X? Of course there is, right? So, but with Katerra, it was exactly the type of company that you want to put a lot of capital in. Real estate is a $1.8 trillion industry. It represents 23, in the US alone, 23% of global GDP. And the industry has not adopted technology, and you could dramatically change both the cost profile, the quality profile, and the timeliness to build. And so that's where capital in building a full stack technology solution, from design to construction to maintenance to remodeling to smart home automation and tracking. If you're building that whole stack, you need a lot of capital. And why no one's ever done it is because you need billions of dollars to do that. But the market they're addressing is enormous and highly fragmented, where the largest global player in construction has less than 1% of the global market. So you can build a very, very large business with only having 1 or 2% of the market. And so you could deploy a lot of capital to build, buildings that cost $300, $400, $500 million up to $2 billion skyscrapers. So in that case, that was exactly the right strategy, was deploying a lot of capital.
So I think I'll give you another example where we're deploying capital and turbocharging the company is very current. It's Oyo, because our investment history went from leading a $60 million round in summer 2015, followed on by another $60 million round 1 year later. And in that meantime, the company basically, beat all competition and went from a hyper-competitive, all VCs-backed companies fighting for market share, fighting for that leading position, and that company won the game. And it's becoming clear that they were the leader in India, and Masa and the deal team encouraged Ritesh, the founder of Oil Rooms, to enter the Chinese market. Now imagine a young Indian kid, what does he do in China, right? Does he have conviction? Does he have the right team on the ground? And he did it. He managed to assemble a team and built up a enormous room supply in the unbranded budget sector. And we have conviction. We understand that this is what's going to take to succeed in China, and which led to today's announcement of our follow-on investment.
But like you said, there's big rounds and big rounds, and some of these fundings serve as sort of companies aren't not going public because they're raising so much money, which leads me to another criticism or concern, which is that you could actually, no kidding, like ruin the venture model, because you sort of sustain these companies. They're not able to exit. LPs don't make their money. LPs stop funding VCs. I mean, it's sort of dramatic, but is that a concern, or like is it just perfectly fine with you if SoftBank's like the last person standing?
Yeah, we're not worried about that, and I think again it's a misnomer. So a couple months ago, the CEO of the NASDAQ was giving a speech here in San Francisco, and she got fielded the question, isn't SoftBank ruining the IPO market? And she said, quite the contrary. What it's doing is giving, an average company is private for 13.2 years. By the way, that was 13.2 years before the Vision Fund was created. She said, so when companies finally get public, they're much more professional. They have larger revenue bases, larger profit bases, and they're more successful and mature when they come public, and we're going to get those companies to be listed on our exchange. In terms of, if you look at the traditional venture model, the LPs will invest with a 5 to 7 year time horizon, though most funds are 8 to 10 years with 2 one-year extensions, and all they do is recycle the money again back into the fund. So it's an artificial kind of time frame if they're just going to deploy that capital back into Fund 2 and Fund 3 and Fund 4 with the same venture capital. It's an artificial time frame. If you're going to force a company to have a liquidity event and suboptimize the size of the franchise and the total profits that can be made because of some artificial time frame, who is that serving? So we're coming and playing a slightly different model, and SoftBank's not for every company and every entrepreneur. But in the case of Oyo, we had amazing partners in Lightspeed and Sequoia and Green Oaks and sophisticated investors going, yes, product market fit, this company's going really well, let's raise a large round so they can expand globally. And so we partner. You said a lot of VCs don't like it. It's complete opposite. I used to have a lot of friends in venture capital. Now I have a lot more because we're coming in and we're providing the liquidity event for them because they've been in 4, 5, 6, 7 years, and we're happy to combine a secondary with the primary investment, give them an exit strategy, and then align the time horizon with the new investment with what the entrepreneur's vision is. So I don't see that we're ruining the venture model at all. I see us playing a slightly different game, but providing more options and choice for entrepreneurs who don't want to go public.
That was a good counter. I have more questions, but we're out of time, and I wanted to give the audience a chance to ask some questions if they'd like. Oh, Kia, here.
Hi, I'm Kia with Axios. Anyways, how do you guys sort of pick which deals are going to be Vision Fund and which deals are just SoftBank? I feel like once in a while we get a so-and-so raise $100 million from SoftBank Group and not the Vision Fund, and it's sort of, how did that work out?
Yeah, so I think we were describing the terms of our LP agreement, so that there is a referral obligation for deals under $100 million that goes to other pockets of SoftBank. So there's the SoftBank Group core balance sheet, and there we still have an early stage venture platform in SoftBank Ventures Korea, and this is where you see some of the headlines and their recent activities.
Any other questions?
Why don't you have offices in China and India, given the size of those markets for venture capital or private?
It's a great question. Anna and I have way too many frequent flyer miles as well as our colleagues.
Yeah.
So we are spending a lot of time in region, and we're starting to contemplate, should we have people on the ground? Today, we just give United a lot of business.
We're year 2 in the fund, so we'll get there.
Hi. I would think that with the amount of capital that you invest, you are accelerating the disruption in traditional businesses and corporations. So I'm just thinking, have corporations reached out to see how they can partner and maybe just build that bridge with potential companies that would take a lot of share from them, but they don't want to give it away, so they want to be part of it?
It's an insightful question. The companies and the entrepreneurs we're backing, right, they're often not inventing new industries. They're creating a better mousetrap and taking share from the incumbents. And the incumbents are trying to figure out what to do regardless of SoftBank, right? This trend has been happening. How do you break through the innovator's dilemma? How do you create new R&D within your company? And particularly public companies are hamstrung by EPS and EBITDA targets out there. So a great example where a company I think did a really interesting bet was GM. They went out and bought Cruise. And then through partnership, they were looking at how do we make Cruise even bigger and better in what they're doing. And they partnered with the Vision Fund, and we invested a meaningful amount of money into what could be a very large technology play. And why we did that was because, one, Cruise was an innovative startup, and GM and their management team had an expansive vision that you don't often see in companies. And so they want to preserve that innovation. They leave Cruise largely to run self-operating, but pull and harness the benefit of having millions of cars on the road across the world with distribution capability and knowledge about automobiles. So that's a great example. We've had other large Fortune 1000 companies come see us. Some of them we get very excited about looking at things together and partnering, but that's a fairly limited number because most of them are still stuck in a model that is determined by kind of the constraints that they live in as a public company. So we're happy to partner with other venture firms, other private equity firms, sovereigns, or large corporations, as long as there's alignment and vision around what we're trying to accomplish, the time frame, who's going to run it, and what the outcomes can be.
I wanted to ask, I was interviewing Doug Leone of Sequoia Capital a few weeks ago. And we were talking about this $8 billion global fund that they've raised, and they've raised separately billions of dollars in other funds. And he said, we want to be another option for our companies as they go on. We invest in them at the seed stage, at the Series A, B, C, D. We want to be friendly capital. I mean, he actually didn't specify SoftBank specifically, but he said we don't want them to, be part of a stick-up. Are you going to have to evolve? You've changed the landscape, but the landscape you could sort of see like evolving to sort of live with you. Do you see going sort of earlier into companies so that you have established relationships with them? I mean, if these VCs sort of don't let you have access to their best companies, you could see that being a problem down the line.
So a couple of thoughts. One, Doug is amazing, and Sequoia's track record is unapproachable, right? So they have a formula and a business model that has worked over a long period of time for them, and they're starting to adjust. And basically what they're saying is, we get to see the A, B, C, D, and we get to do follow-ons in the ones that we see traction in. And so let's raise large amount of capital, not because just SoftBank, because there's Co2 and DST and TPG and SoftBank. There are a lot of pockets of capital, and so it was a very logical response to the changing dynamic in the landscape, not just a reaction to SoftBank. As it relates to us, it's not that VCs can hide or hold back their portfolio companies, because we know who they are. The entrepreneurs reach out to us directly. We form relationships months, years ahead of where we might invest. So I spend a lot of time with companies that are in the Series A, Series B, and so I get to know the entrepreneurs, understand their model, happy to be a mentor and a coach to them so that when they're ready to take on large amounts of capital and late stage growth, we've already formed that relationship, and it's a self-selection process. They're like, great, we know Jeff, we know the SoftBank, we know my partners, and if that's the right choice for them, then we already have that relationship. So we don't think a lot. It's kind of like great entrepreneurs. You got to be conscious of your competition, but you can't let the naysayers change your game, right? Because that's what makes a great entrepreneur. She hears all the reasons why you can't, and she still perseveres to go forward. So we're thoughtful about the competition and the broader ecosystems that we operate in, but we really have our strategy, and we're focused on delivering on our strategy and not terribly distracted what others are doing.
Well, Jeff, Anna, I know I've kept you here too long as it is. Thank you so much.
for having
Really
us.
appreciate you coming.
Thank you.
Thank you.